This is Atilla Yeşilara, and this is the Real Turkey channel. This time we're going to talk about Turkey's external balance. That's trade deficit or current account deficits. I picked this subject for our broadcast because there has been a sea change. Events are changing very rapidly with a potential impact on Turkish lira and the bond yields, which I think our audience, whether they are financial investors or those who trade with Turkey, ought to know. Once again, I like to put these broadcasts into a broader context to become more comprehensible. My wife says I'm completely incomprehensible. Turkey has staged one of the most incredible trend reversals in terms of current account deficits. Roughly 15 months ago, Turkish current account deficits were ranging around $50 billion, or 7% of GDP. Within a year, thanks to the great services of our economy czar, Mr. Berat Albayrak, we have completely closed the current account deficit. And in fact, as of the last data point, August, I believe, we produced a current account surplus of 5 years. So Mr. Berat Albayrak took credit for that and said, Turkish economy has rebalanced. He further added that we rebalanced by changing our production structure. Now we produce a lot of things at home, so we don't need the imports. Therefore, from now on, we're going to be able to grow without current account deficits. Horse manure. We have a sister website called paintelligence.com. I put a report up there, you can check. We analyzed or segmented the change in current account deficit into the increase in exports and compression of imports. Exports over the interim only increased by $15 billion. So 3/4 of the shrinkage in current account deficits came from import compression. In other words, we ran out of money to import. Since we import energy, inputs, and intermediates, Turkish economy came to a standstill too. So the current account deficit was closed at the expense of stopping the Turkish economy. Now, of course, even if you completely stop GDP growth, at some points, import starts growing. And that's the story I'm going to tell you. First of all, I want to praise our exporters who, despite extremely tough conditions, no financing at home, Turkey constantly quarreling with Arab countries and EU, which is our main trading partner, a magnificent achievement in terms of marketing their products and services abroad. Unfortunately, that miracle had run its course as of September. In September, export growth vis-a-vis the same month of last year stopped. In October, our exports, again, compared to the same period last year, declined by $250 million. Over the last 12 months, our export growth declined to 2.3%. And it's not going to get better for the simple reason that EU is rapidly heading towards stagnation. And since roughly 50% of our exports go to EU, even we try very hard, if they're not buying, we can't be selling. And the Turkish lira is not depreciating anymore, thus depriving us of any advantage that the cheaper exchange rate might proffer to us. Iran, another major export destination, according to IMF, has shrunk 10% this year. MENA countries, Arab and North Africa, is a major trouble because, as you might have read, Syria is dead, Iraq is embroiled in massive protests, and we have certain political disputes with Egypt, Saudi Arabia, and the Arab Quartet, who are in the process of staging boycotts against Turkish goods. So the Turkish export picture doesn't look good. Next year, ceteris paribus, the conditions not changing, Turkish export growth will not exceed 5% in value terms. On the other hand, import growth in October vis-a-vis the same month of the last year has already accelerated by 10%. It's not scary yet, but 10% is an important number. You gotta remember that our imports are 1.5% times bigger than our exports. There's a problem here. Import growth is tolerable if imports are being converted into production and thus to exports. But that's not the case. Most of the imports are coming from consumption goods simply because banks have cut interest rates too low, and there's a mini consumption boom. Two, in a previous video, I remarked that Turkish factory price inflation declined to 2%. And I'm like, all the input prices increased, like energy increased by 60%. How is that possible? The answer is simple. Turkish companies didn't produce much over the last year. They simply liquidified their inventories, their stocks. And that process has reached a culmination. So they are not increasing production, but they have to replenish their stocks. So they're buying at expensive prices. This is why imports are going up. Since growth is still too slow, I don't expect an import explosion. But next year, this time, Turkey will have a trade deficit. We expect 2% current account deficit next year. That's roughly $14 billion. So the turnaround from the current account surplus to next year's data would be roughly $21 billion, which brings up the question of how do we finance that? Because the balance of fee financing has been disastrous. Turkish balance of payments relies on foreign credit. We don't get much of an FDI. Hot money flows have dried up since local elections when we shut down the swap market. Turkish companies borrow abroad through bills and bonds, and Turkish banks borrow abroad through syndicated loans. As of the last data point, Turkish banks are rolling over only 65% of their maturing loans, and according to Fitch, Turkish corporates have reduced their rollover ratios to 97%. I expect that ratio to go to 90%. Turkey is currently paying off its debt. It's called the deleveraging process. That process is going to accelerate simply because there are no profit opportunities at home. On top of that, because of the very low interest rates in TL deposit, Turkish retailers and savers are switching to hard currency deposits, which reduces the supply of deposits, FX deposits at home. So even though a current account surplus of 21 billion within a year is a small number, financing that is going to be a problem. Banks or corporates will have to increase borrowing, which runs into problems because despite the Fitch update, Turkey still is a double B or B country, which means we're not investment grade. And if you want to borrow more, you pay higher spreads. There are other issues which stand as obstacles to our foreign borrowing, such as sanctions from the United States, the halt bank case, our ongoing conflict with EU, which might lead to reduction of European banks cutting their exposures to Turkey. As a result, even though the sums are small, we have to be extremely careful in terms of meeting our financing needs. Not that there's going to be a crisis, but there could be some pressures on the exchange rate, and domestic interest rates might increase. What really scares me is that nobody believes in the next year's budget deficit target, which is 2.9% of GDP. reasonable figures. I've heard figures like 6% of GDP, but reasonable figures suggest 4%. So a rising current account deficit plus a 4% budget deficit to GDP ratio makes Turkey a twin deficit country, which is not good for financial investors. In other words, the story of Turkey rebalancing and primed for fast growth with imbalances is just a dream, a pipe dream. Whatever people are smoking in Ankara, I want to, get the phone number of their dealer. This is Atilla Eşli, smoking happily in Istanbul. Bye bye now.